Well, as promised, let's get to our next conversation then. And we have with us in the studios Mr. Sudipta Roy, Managing Director and CEO at L&T Finance. And we have three main points that we want to focus on with the company today. AI has become a big talking point for L&T Finance, and they alluded to this in some of their conversations with investors earlier, caused a bit of a flutter on the stock as well. So we'll understand more about this. And then, of course, we want to understand the usual metrics, the ROA, NIMs, all of the usual metrics in the outlook for H2, and an update on what's happening with asset quality as well. So let me straight away get to point number one with our guest. Sir, thank you so much for joining in. It's great to have you with us, Mr. Roy. Let's start with the AI, because what you, I think, mentioned to the street earlier was that now you're adopting AI in a manner that it improves your collections and your yields. I think that was really noticed. What exactly is happening? Is it beginning to make a meaningful difference? And then if you could give us some numbers, I mean, typically from wherever yields and collections are right now, how do you see those numbers improving? Over what period?
Thank you, Suri, and thank you for the opportunity. Obviously, we have been one of those institutions who have started to adopt what I call AI at scale. And if you look at our sort of 4 areas where we are piloting multiple solutions, first is obviously onboarding, underwriting, servicing, and last but not the least, collections. Now, the place where we started to deploy it very, very early was underwriting. And we look at AI at a 3-step process. Most people think when you talk about AI, think about Gen AI. But we look at machine learning, deep learning, and Gen AI obviously at the pinnacle of it. Most of our underwriting engine, for example, which is almost now 20 months into running and version 3, is deep learning based. And we deployed it for the first time in our two-wheeler business. We started with maybe about 14 models running. Now we have close to about 18 to 19 models running on that. And the fact is that if you look at the impact of that, and as you know, in the industry, two-wheeler industry, through the door bounce on underwriting, especially when portfolio bounce is anywhere between 23 to 24%. In exactly 20 months of running, and full-fledged implementation happened in January of this year, so I can say 9 months, our portfolio bounce is down to about below 15%. And our through the door bounce is now coming about 7 to 8%, which is almost equivalent to a prime personal loans bounce. What it does, and we actually also validated it through CIBIL. If our portfolio risk on our non-AI model underwritten portfolio was, say, at 90 plus at 12-month on books was 4.5%. My current portfolio, which is underwritten through Cyclops, which is our deep learning-based underwriting model, is currently running at about 3.2 to 3.3. So almost 150 basis points has got shaved off. Right? So obviously, it will take some time to show in the full book, because I still have a back book which is there. But as we progress forward, the portfolio will clear. And we have implemented now in two-wheeler, SME, tractor loans.
This is at the underwriting level.
Yes.
So also the question of cost has to come in, right?
Yeah.
I mean, to what extent has your software cost or technology cost gone up? And there's a cost-benefit analysis.
Yeah, absolutely.
And what should your investors watch out for over the next 12 months as you apply this to the rest of the portfolio and to other areas like collections, like,
So very good question. We spent overall 80 crores to build this underwriting tool. And on our automated portfolio management tool, we have spent about 25 crores to do that, right? And obviously, as this builds across all lines of products, the cost will. But we amortize this cost because these are literally software products, right? So we amortize this cost over a period of time. And what is not normally visible is that you have a credit cost. But the cost of credit administration on top of the credit cost is almost equivalent to that of the credit cost.
Basically, to recover 100 rupees, you need to spend...
You need to spend 50, 60.
So that goes
actually
down
160 rupees. Yeah. So, for example, I'll give you the example of the two-wheeler business where we have the maximum experience. If your credit cost was, say, pre-Cyclops was 3.5%, your cost of credit administration was 2.5%. You total it up, it comes to about between 5 to 6%. Now, directionally, your credit cost can go down to close to 2%, and your cost of credit administration becomes about 1.5%. So you actually save 200 basis points on that. Though you front load the cost in building the tool, you tend to
the tail is long in that sense.
Plus also in AI in collections, an average physical call and human call, right? Okay, call conversion rates in human call, etc., are roughly about 67 to 68%. But average human call fully loaded cost can vary between 600 to 900 rupees, depending upon the length of the call. An average AI call for us is 38 rupees in terms of collection cost. And okay, success rates are lower.
The conversion rate?
55% success rate, 55% success rate.
But even adjusted for that, I think it's
You're adjusted for that. And the fact is that some of the new sort of models which are coming, right, you actually cannot make out the difference. In fact, the AI tool interrupts you in between, and that's almost human-like.
We'll come back to AI. Just Mr. Roy, thanks for dropping by, first of all. And I must say, in a market which has been tough, Surabhi, the L&T Finance stock has doubled this year in 2025. And
so,
you're completing 2 years, Mr. Roy?
A little more than 2 years.
A little more than 2 years.
A little more than 2 years.
So, okay, let's just, I want to start with microfinance. I'm sorry, I'm diving straight into some segments here. It's about 25% of your book?
Almost, 25, 26% of our book.
Okay. Now, this was highlighted to us by an investor that while, and we spoke about this at the NBFC event, that things are turning. I mean, we're at perhaps the cusp of an upcycle in the microfinance space. Is that panning out? I just wanted to get a status check because some of the data indicates otherwise, that things are still deteriorating. I mean, it's not moving up. The pace of change is actually deterioration, not improvement. So just wanted your sense.
See, I am in the business and I look at the numbers daily, right? And I'm sort of biased by the numbers that I see for my
that's what we want. I mean, what your numbers
my
are.
Organization. So at least L&T Finance, we are doing pretty well, right? In this, the fact is that our disbursements have been growing with every passing month. So in fact, we just finished a month yesterday. And the fact is that we have been above 2,000 crores of disbursements steady state for the last 3 to 4 months, right? Collection efficiency for us has been improving secularly month on month. And when I say secularly in a month on month, about 6 to 8 basis points upwards tick every month, right? So, last month when we ended last month, we were at about 99.57.
This is all microfinance?
All microfinance.
Okay, please.
99.57 pan-India. Now, this month we are a little higher, right? So, and Karnataka, for example, which actually was sluggish for a long period of time, actually broke through about close to 99.4% this month, right? So, which is not exactly near normal. For us, near normal will be between 99.65 to 99.7. We're still 10 basis points as my organization away from normal, which is about 99.7. See, the industry, again, has been improving. And I've been talking about in the industry, so the industry has been improving. But the pace of improvement is not that fast to the extent that we would have liked. Plus, also the industry has a liquidity issue, right? So the fact is that there is a lending gap in the market, right? And some of the larger, stronger players are able to lend. And that is why MFIN has made a request to the government for having a refinance facility for the entire microfinance NBFC MFIs to see whether the government agrees to that or not. And but the fact is that the industry, I would say, is out of the woods, if I might want to use the term, out of the woods. It is in that long tail normalization period, a little bit of liquidity will help, because what happens is liquidity also starts the cycle also. But couple of points. Rural wage growth rate has been good, 6 to 8%. Rainfall has been good, right? Kharif crop arrivals are good. So I expect H2 to be significantly better than what we saw in H1. And I think Q4 is when you will see normalcy in this industry, subject to liquidity coming back.
All right. Hi, Mr. Roy. Good to have you in the studio. And I recall the last time we chatted with regard to that Karnataka issue. You told us the efficiency will improve in October. You've been spot on. October, November is when things have been improving out there. And most of the guidance as well you have gone to. And that explains why from March itself, I think the stock is up 75%. That said, let's focus on a few numbers since, you were drifting us towards that. The return ratio, that's going to be important. You're guiding for better ROAs as well as ROEs. So give us the number with the timeline and what the levers you have in place to take you up. I think on ROAs, you're guiding for a 40 basis points improvement. Tell us by when and the levers as well.
So we're currently, last quarter we were at about 2.41.
Yes.
So what we have guided the markets is directionally we should be in the range of between 2.8 to 3%. Exit FY27, which means around March of March 2027 is when we will be at that particular level, right? So, and obviously a couple of things here obviously has to work. The credit cost has to come down. As you know, our credit cost was 2.4. Incidentally, our ROA and credit cost actually were the same last quarter, 2.41 and 2.41, right? So obviously the credit cost has to come down, and the various initiatives that we have been doing is obviously showing a positive impact on the credit cost trajectory. The microfinance sort of industry also has to stabilize. You know, the fact is that we got a burst of sort of NPA coming in from the Karnataka sort of challenges, right? And obviously we delayed the recovery.
Right.
Now I expect FY27 to be a period, every quarter will improve the trajectory on the credit cost, and we have said that the credit cost will directionally move towards 2%.
Right.
Because of the AI initiatives also. You said 2%.
Yeah, it will.
All of it put together.
It will take time to show up because we have a drag of a back book, right? So for us, the situation is peculiar. We have a newly generated book through some of these tools, which is showing excellent results, and there is a drag of a old legacy book, which I called. This will take time to sort of show up in numbers, and it will do so in Q1 and Q2 of next year, next financial year. And I'm very, very confident that, you know, and it will also have an impact on the collections costs as well. So on the cost, etc., cost efficiency, you will see an impact. NIMs and fees, we have guided that, you know, NIM plus fees together, we will try to guide between a corridor of 10 to 10.5%.
Okay.
We'll try to maintain that. And with microfinance coming back, and it's a high yield product, and plus also we have added gold loans. We are adding 200 branches this year. We'll add 300 to 350 branches next year. So basically for the next sort of 1.5 years, we'll be opening one gold loan branch every day.
All right. Just tell us a little bit more about that gold loan portfolio, you know, because you have tapped that market just in the recent past. And I think the book as of now is around 1,300 crores.
1,500 crores.
1,500 crores. And as you're saying, you're looking at opening more branches.
Yes.
And you're looking at penetration out there. So going by all these estimates that are put down, what should the book look like, say by FY27 and from thereabout? You know, targets on the size of the book and timeline as well.
So we expect to be anywhere between 4,500 to 5,000 crores of book exit FY27. That's what we intend to do. And by that time, we should have... See, we got 130 branches. We'll be at 200 branches this year. So we'll be about 330 branches by March. We'll add another 350 branch by next year. So we'll be about 700 branches odd.
So I mean, clearly, microfinance is coming back. You're building the gold loan business as well. Retail has been anyway doing, you know, fairly okay for you. In terms of just growth of the book overall, AUM growth, I think you've guided for 20 to 25% for this year, whether you're on track for that or not. And even next year, I mean, what is the steady state growth rate you're looking at now with microfinance issues largely perhaps behind us?
See, festive periods was good, right? And the fact is that, you know, I'm reasonably confident that, and microfinance is coming back, you know, gold loan disbursements are good. You know, two-wheeler, you know, we saw a very good month in October, though this month it has sort of stabilized to a large extent and come into a normal trajectory. I'm pretty confident that overall for this year, we should be at about the 20 to 25%, you know, benchmark. Next year, again, we have to see, you know, next year, again, if you see microfinance, you know, I think this business, the safe speed for this business is between 10 to 15%, right? But, you know, we will have a couple of high growth businesses. Personal loans has been growing at 40% plus for us. And if you look at our digital origination of personal loans, we probably are growing at about, you know, on a quarter-on-quarter basis, about 30-40% on that as well. So personal loans will continue to grow well. Microlab, small book is growing well. Gold loans will go strongly. SME business for us, small base, but it's been growing well. We saw a little bit of risk on the lower end, sub 20 lakhs, but that's not a very large part of our portfolio. So we continue to grow well on that as well. So overall, again, next year, overall, and as we sort of announce our Lakshya 31 targets, right, in the month of April of 2026, we will want to be within that corridor, because the fact is the targets that we are taking, you know, between 20 to 25% is a safe speed to grow any sort of retail lending business. And the fact is that in our Investor Day, we articulated there, we are a risk-first, tech-first, diversified financial player. So we will grow to the extent that we are comfortable with risk. Now, if that means that shaving a couple of basis points from the growth rate, so be it. But 20 to 25% is good enough.
And I think that'll be good enough for the market as well. If you're able to do that consistently, I think the key word is safe speed.
That's right.
Safe speed. You don't want roller coasters.
And just quick, last 10 seconds, allow me to add this. The Japanese are lining up with money. People from the West Asia are lining up with money when it comes to Indian BFSI. There are deals galore. Some of your larger NBFC peers, there's still a lot of buzz that they could be looking at.
You've warmed him up. He knows what's coming.
You know what's coming. I mean, and you have so many growth plans, right? Plus you're spending on tech, all of that.
Yeah.
Capital needs, would you look out for a fresh equity partnership?
Not really right now, because you see, we had a equity partnership with Bain for a long period of time. They exited, and after that, I think we are well capitalized. Our parent, obviously, has got deep pockets to attend to any of our capital needs. So as of now, I think our focus is on execution, execution, and execution.
All right. Thank you very much for dropping by, sir. Really appreciate it. And thank you
so much.
for joining us here on CNBC-TV18. Great chat. 80 points, by the way, on the Nifty. We're at about